Welcome. Today is Monday, December 5th, and I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. We're going to kick right off here just with a brief 10-second commercial. You guys all know that I do a free newsletter. We just published our year ahead outlook on December 3rd. So it's fresh off the press as of Saturday. It's free to subscribe. You can access it on my website, jwhinvestment.com. Within this newsletter, there's actually a member upgrade option for those who want more content from us. So we kind of look at the big picture. We entitle it affectionately Huge Insights, the big picture, looking at kind of macro perspectives. But we do stock picking, and that's really what we're known for. And so if you're looking for idea flow, if you're looking for ways to implement our views, you can become a member for as little as $10 a month and get 4 of our top stock or ETF ideas each month, once a week, every Wednesday at 12 noon we publish. So with that, let's kick off with chart number 1. Chart number 1 is just a primer of what is known as the Elliott Wave Principle, or the Wave Principle, as Ralph Nelson Elliott dubbed it. R.N. Elliott actually did his original work on this subject back in the early 1930s. He evaluated about 75 years of market data. Ralph Nelson Elliott was actually a CPA at the time, and he became ill and was bedridden for a number of years, and so had lots of time on his hand, and decided to hand chart the daily closing prices of the major indices, going back as far as he could find the data for it, and in fact created what he later dubbed as the Wave Principle, which was detailed in his book entitled by the Wave Principle. He co-authored that with Charles J. Collins back in 1938. And it was such a hit that Elliott would go on to write 12 articles on the same subject for Financial World magazine, further describing his market method for forecasting. So just to describe it in short, the Elliott Wave Principle is really just an interdisciplinary framework utilizing concepts from the fields of behavioral economics and fractal geometry that can be used to identify self-similar patterns, or wave modes, as Elliott described them, in the price action of most publicly traded securities and broad market indexes in order to make probabilistic judgments about the current and future path of prices. So there are only 2 wave modes. There's a motive wave and a corrective wave. The motive wave actually defines the direction of the trend for prices. The corrective mode is a counter trend interruption that allows supply and demand to kind of rebalance. And, as in life, with progress comes fluctuation, kind of a 3-step forward, 2-step back. And it emanates gradually and then suddenly. So the diagram that we're looking at here is one that I really just pulled off the internet. Anyone can find this, and gives you kind of the basic substructure of an Elliott wave. A motive wave is 5 waves in the primary direction of the market. And so, we count them 1, 2, 3, 4, 5 up, and that is a complete pattern. But within wave 1, wave 3, and wave 5, they are also motive waves. Waves 2 and wave 4 are counter trend interruptions. And so this takes place at every conceivable degree of trend. Elliott actually proposed something as long as millennial wave. But we use, in our notation, we start at minor wave, we go to intermediate wave, we go to primary wave, we go to cycle wave, and we go to supercycle wave. That's the largest degree pattern that's ever been observed in human history. And so that's where we begin today. And let's move to chart number 2. Chart number 2 is our interpretation of the market's price action, going back as far as S&P 500 data exists. And so that's roughly 1926 or so. And we imply that, overlaying the Dow data prior to that, we come up with the same sort of 5-wave structure into what we've defined as supercycle wave 1 in 1929, which was followed by a crash, obviously, that resulted in the Great Depression. That crash ended in 1932, and we dubbed that as Supercycle Wave 2. Everything off that 1932 low to the top experience this year in January of 2022 is, in our opinion, Supercycle Wave 3. And that subdivides into 5 cycle waves, 1, 2, 3, 4, and 5. And cycle wave 3 subdivides even further into primary wave 1, 2, 3, 4, 5. And at each of these points, we can see very clear three wave interruptions, marking wave 2s and wave 4s. And so, when we get to cycle wave 3, we see what everybody concludes is the tech wreck and the great financial crisis. And that's really wave A, B, and C of a cycle degree corrective waveform that was really cycle wave 4 of supercycle wave 3. And so everything since the 2009 low was cycle wave 5 of supercycle wave 3. And so that 13-year advance, that Fibonacci 13-year advance, concluded, in our opinion, on January 4th of this year. And so we put a little red box there to just kind of look at everything off the March 2020 low to present. And that's where we're going to focus our attention right now. In our view, that really is what we're trying to understand, whether we're seeing a major trend change here or not. And so far, what we've determined is that we are in the very early subdivisions of a major trend change. So let's take a look at chart number 3 to get a little bit more perspective. What we've done is we've kind of taken that little red box and we've blown it up, and we've looked at all the subdivisions of the waves at weekly degree of trend. So primary degree of trend, really, or use a weekly price bars here to determine that. So off the March 2020 low, which was primary wave 4 low, so everything up to January of this year was primary wave 5 of cycle wave 5 of supercycle wave 3. And everything after that is what we're trying to figure out here. So we counted 5 waves up to complete cycle wave 5. And under that rubric, the decline off that January high counts best as the beginning of a 5-wave motive wave decline. And so, we count 5 waves down into the June low, and we consider that to be primary wave 1 of cycle wave A down. Everything after the June low was a rally into the August high. That is primary wave 2. And from the August high, we count another 1-2 progression at intermediate wave degree of trend. So 1 down into the October low and a 2 up into the current price high, which was actually December 1st. And there may be a little bit more to go on the upside. We'll see, but not much if this count's correct. Now, there is an alternate to this perspective, and it's possible that, the initial decline off of this cycle degree high is not unfolding in 5 waves, but it is instead unfolding in 3 waves at primary degree. Under that rubric, we would be looking at our alternate count. And the alternate account assumes that the 5-wave decline from January to June was primary wave A of cycle wave A down. And so everything that follows the June low is part of a corrective pattern known as a flat in Elliott Wave parlance. And so the advance into the August high was intermediate wave A, the decline into the October low, which slightly exceeded the June low, which is very, very typical of a flat, that counts as intermediate wave B. And then everything since the October low is part of intermediate wave C up, which when complete will terminate primary wave B of a 3-wave A, B, C decline, which should culminate in the termination of cycle wave A of a larger ABC pattern that was described in the prior chart. So if in fact these counts are correct, then there's really only these 2 options. And the question is, how far can the market go if it dramatically exceeds the 200-day moving average? And we've kind of targeted the 61.8% retracement of the decline off the January high to the June low. That would bring us to around 43.65 roughly. But at this point, we ascribe a much lower probability to the alternate count than we do to the preferred count. The preferred count looks correct to us, and a break below 3906 would confirm it. And that would suggest that we are in the midst of intermediate wave 3 of primary wave 3 down, or a third of a third wave decline, which should be a dramatic decline. Let's take a look at chart number 4 to get some shorter term perspective. So we've blown it up even further. This is an intermediate degree model dating back to August of this year. So we're counting the August 16th high again as primary wave 2 of a 5-wave motive wave decline, which will ultimately be which will ultimately prove to be cycle wave A. And so this decline off of this August high is a clear 5-wave decline, and it counts perfectly and meets all of Elliott's rules and guidelines. The rally off of the October 13th low, which we mark as intermediate wave 1, is a counter trend advance. It is very choppy, very overlapping. It's an ABCW with an X wave and another ABC that appears to be unfolding to the upside. Now, the target that we've had for this for the last several weeks now is 4118, which is where wave Y would be equal to wave W, a very common wave relationship. Another possibility is that it pushes slightly further to approximately S&P 4147. That would be the 78.6% Fibonacci retracement of the August-October decline. Either one of those would be valid targets. We think if we didn't peak on December 1st, most likely we're going to push up to one or the other of those before the market tops and reverses lower. Again, a break below 3906 or roughly that level would confirm that the next leg down is in play. Now, what makes us so certain that we're on the precipice of a big decline here? Well, let's move to chart number 5. Chart number 5 is the volatility index, the VIX. And what we do is we basically look at it on an overbought, oversold basis, just to kind of model the momentum of volatility. And what we see right now is an interesting setup. This is a positive divergence that has now become evident in the short-term momentum study of the VIX. And that positive divergence is actually indicative of a potential low in volatility here. Now, the other thing is that historically, when the VIX has become this deeply oversold, it has always been a prelude to a volatility spike. And actually, just looking back over the past 3 years or so, each time the 6-day RSI oscillator has reversed sustainably from an oversold condition, the VIX has spiked over the subsequent 1 to 3 month period into about a 30 to 40% range. Now, it's our current view that this setup is now more extreme than any that we've seen in the past 3 years. And as such, we should be on alert for a volatility spike in the very near term that could potentially propel the VIX above 40%. That, in our opinion, would be something that would be concomitant with a decline in equity prices below that 3906 level. With that, I want to just invite you all to reach out if you've got any questions. Like the video if you do like it, and make comments if you've got comments to make. And thanks a lot for watching, and I wish you all the very best trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.